Welcome to Venture Podcast, presented by VNTR, the world's leading investors community, the place to learn from VCs and capital allocators.
I started investing probably about maybe 20 years ago, angel investing, maybe a little bit before that, but probably got more active in angel investing around 2003-4 when I was leaving PayPal. I'd had a background in engineering, and then I'd had a career in as well as engineering. Kind of was able to people both who were building products as well as kind of raising capital and talking to investors. And three ways that VCs lie both to themselves and to the rest of the world. And that is their winners are marked too high, their losers are not written down or written off, and whatever the residual value is of the remaining portfolio is still an illiquid asset. And so if you're buying that for cash, you're going to discount that even further.
Welcome to VNTR podcast. We are hosting Dave McClure today, and we will discuss secondaries and secondaries in funds. And Nico Leon is joining me today to interview Dave and learn more about Dave's current activities and the trends that he sees and the future that we should expect in venture capital. Dave, welcome. And please introduce yourself. Many know you, but please introduce yourself.
Sure. I'm a nerd that's been here in Silicon Valley for over 30 years. I started out as a software developer, database engineer, gradually shifted over to being an entrepreneur. I've done a lot of community events for entrepreneurs and investors for a little while at PayPal before the IPO and through the acquisition by eBay. Got to meet a lot of really amazing folks there, people who started a bunch of other crazy, awesome companies like YouTube and LinkedIn and others. Got to work with Peter Thiel and Sean Parker at Founders Fund for a little bit before I started my own firm, previously called 500 Startups back in 2010. Raised and managed most of the first four funds there. Did a lot of early stage investing here in Silicon Valley as well as around the world. And then started a firm called Practical Venture Capital, which is a bit of a joke because it's not. And we focus on investing in secondary positions, mostly at the fund level, but also in companies. We started that about 4 or 5 years back. Have raised two funds there, and now working on raising our third fund.
So you mentioned that you are an entrepreneur. So why did you decide to invest in startups? Why not focus being an entrepreneur?
I guess because I feel like I'm maybe an okay entrepreneur, but not an amazing one. I don't know. Maybe I've had harsher criticism for my own entrepreneurial efforts in the past. I sort of feel like I've kind of moved down the stack, right? So I was pretty good programmer. I was kind of a crappy entrepreneur. I don't know. Maybe now I'm getting to be a better venture capitalist. I think one thing about living here in Silicon Valley and meeting a lot of amazing people is you tend to develop a really big inferiority complex, imposter syndrome.
Yeah.
And I got to work with some really fantastic people who did start, name brand companies on the internet. So sometimes you kind of compare yourself to those people and you think, wow, I'm a fucking idiot. Hopefully I'm not an idiot, but I guess I would say maybe I'm Salieri to the Valley's Mozart's.
So you met all these great guys, and how did you choose who to give money to?
Well, I think I started investing probably about maybe 20 years ago, angel investing, maybe a little bit before that, but probably got more active in angel investing around 2003-4 when I was leaving PayPal. So I'd had a background in engineering, and then I'd had a career in marketing as well as engineering. And so I kind of was able to connect with people both who were building products as well as kind of raising capital and talking to investors. And being able to speak maybe both of those languages, gave me a little bit of an advantage in connecting both with nerds as well as business and investor. I say nerds in an affectionate manner. I'm not really criticizing people there, and I am one. But it's hard not to feel inspired when you're living in Silicon Valley and you're around all these people doing amazing stuff. And that's not, just a recent phenomenon. That's been happening here in the Valley for 60, 70 years or more. So even when I moved out here in the late 80s, early 90s, there was already, a pretty long, strong tradition of entrepreneurship. And, I
Yeah.
was here right as the internet was getting started, and that was just, I guess, well, not the internet, but the World Wide Web, perhaps portion of it. And that was just a really amazing opportunity to see a whole generation of entrepreneurship get started. And I guess we've gone through now two or three other generations of, not just the internet, but mobile and social and maybe now AI. So there's continuing to be just a wave, of different new waves of entrepreneurship, but also just a history of and tradition of crazy people building amazing shit.
You spoke about what you're doing before investing, but I think it's always really interesting to talk about how you got started because that's probably the most relatable to a lot of our listeners out there. So, going from working for PayPal, etc., how did you go from that to writing your first check? I mean, was the first investment you made an angel check, or just always really interested in the first steps in those?
Trying to remember when probably the first investment that I made wasn't in a tech company. It was in a restaurant business in San Francisco called Foreign
Oh, wow.
Cinema, uh, which was, trying to remember, maybe 95 or 90, probably 98, something around there, I think. Maybe I did one or two other early investments. I was helping advise a few companies, so there probably were some startups that I did in the mid late 90s, but that wasn't most of, when I got started. It was really probably around that 2003, 4, 5 period was probably really where I actively started writing checks. I mean, small checks, maybe between 25 to 100K, some even as small as 5 to 10K.
And
At
what were your biggest mistakes when you started?
Oh, that's a long list. I think just in general, I didn't know too much about what I was doing. I knew startups, and I had some understanding of it, the engineering and technical side, at least back then. I had some understanding of the marketing and product side, but I didn't know very much about the business of investing, about legal structure, about how to do deals. And so in those first few years, I was really investing alongside some other, really smart people. I got to invest alongside some folks at First Round Capital, some other angel investors like Jeff Clavier and Aiden Senket, to invest with, some of the early days of YC, Paul Graham and others, and some of the folks that I used to work with at PayPal were prolific angel investors, Reid Hoffman and Peter Thiel and a bunch of others. And so that was really, I guess I would say, for other people getting started investing, it's good to have a passion and an interest, but you probably want to start co-investing with people who've done it before so that you can
Hmm.
not have to worry so much about, legal structure and valuation. Let some other more experienced people help you with that as you're getting started. And then gradually, after you've done 10 or 20 deals, maybe you sort of feel like you know what's happening there. So when I first started doing angel investments, I probably did about, let's say, maybe 13 to 15 deals over a period of 4 years, maybe about $300,000 in total. But the first two deals I did were 50,000 and 100,000, which was just stupid. I shouldn't have put that much money to work. In the earliest stages of my career, when I was the most dumb, I was writing the biggest checks, and it's kind of funny. I actually got returns on both of those checks, but they were very modest returns. I think 1.2x and 1.8x, and they happened like 8 to 10 years later. I did get in a few really great companies. I was an early investor in SlideShare. I was an early investor in Mint.com. I was an early investor in a company called Mashery that was acquired by Intel. And those three deals were sort of interesting in that
Hmm.
I kind of knew the people getting them started. They were all fairly quick exits. I think they were probably around 5 to 6 years to get an exit. They were sort of 10 to 20x returns. So that was notable and interesting. And then I also was fortunate to get into a company called Twilio in the early days, kind of when I was working with Founders Fund. And that was probably where there was a different stage of my career where now I was actually starting to, lead a few deals. I was, first check into a lot of those deals.
Yeah.
But those first 4 years when I was doing angel investments, it was kind of like a part time activity. I was trying to hang out with people who were smarter and more experienced, and basically just piggybacking on their deals and their terms. But I had a
So
little bit of
you,
insight.
yeah, so you recommend to use the community and co-investors and piggyback on the knowledge of experienced
Ab-
guys. Yeah.
Absolutely, at least for your first 5, 10, 20 deals, I would say just hang out with other people who have experience, have access to deal flow. Try and see if you can bring something to the table that's useful to the companies or to the investors, but maybe learn a lot as you're kind of getting started there, and then maybe start trying to branch out and do your own thing.
And what do you think
That's
about investing in through syndicates, for example? Like there are lots of syndicates. Is it a good idea to invest through someone
Well,
first?
depends on who's running the syndicate and whether they have the shit together. But yes, I would say there's lots of interesting platforms. We were early investors in AngelList. I had met Naval when he was before he got that started, but originally when it was just an email list, and then later a platform. And he had access to a lot of great companies. He knew a lot of great investors. Some of them were folks we were already co-investing with. Nowadays, I think you can do a lot of syndicate deals, probably online without having to meet the companies, because there's a
But you
lot of
don't
information
learn.
available. No, I think you still can. It just depends on who's running the deal and what
Mm.
information is about the company. I still think it's useful to meet the founders and the companies, but sometimes you can do that online. You don't have to always do that in person. For a lot of people who don't live in the Valley, you can get access to some great deals by working with syndicates, and not just the Valley, other places too. So I think the bar has been lowered for access to a lot of people, both in terms of different parts of the world, smaller checks, a lot easier to do those deals without having to do individual term sheets and sharing that around via email. A lot of things now you can happen online via syndicate platforms.
And what do you recommend to meet these good startups? Because obviously the internet has made everything a lot easier to connect, but obviously with volume comes,
Right.
everyone, not just the good people. So what kind of tips
Yeah.
do you have to meet the good ones?
I think again, just talking to people who have already done it before and have access to deal flow. Ideally, people who are smart investors and entrepreneurs usually are the folks who have those networks. Um, Sometimes people are just deal flow generators. Some people are more knowledgeable domain experts. Some people are natural connectors. So there's a whole bunch of different ways to kind of figure out what you're doing first. Maybe invest across a broad variety of areas, but maybe there's a few particular categories or geographies or stages that you start to take interest in, and in those areas there might be people who stand out as more prolific and experienced that you can work with to get to know things.
So you learned a lot by doing, right? It's kind of you invested
I'm a big
think.
fan of learning by doing. I
Yeah,
think
yeah.
you can read a bunch of case studies and watch a bunch of people, but until you actually start doing it yourself, you probably don't learn those lessons as closely. When you
So
put
so
actual money to
you
work and you give a fuck about it, yeah, then you actually start learning, I think.
so you invested in more than 1,000 companies over the years, right? And
Well, indirectly, yeah. I
yeah,
mean,
yeah.
probably myself, I've probably done several hundred, I would say, probably
Okay.
at this
So
point north of 500, but indirectly several thousand.
what patterns did you identify in the unicorns that you guys seeded?
Oh, I don't know. I think that's a very difficult thing to say that you understand at seed stage or even pre-seed what's going to happen. There's a lot of companies that were run by people who I thought were really talented, and definitely we end up investing early in some great companies. Twilio, like I said, was an example. Probably Canva and Credit Karma, but I don't know if
Yeah.
when you meet those people, they're certainly impressive. Jeff Lawson, in particular, at Twilio, was immediately a very impressive entrepreneur, but that doesn't mean they're always going to be successful. Probably have some survivorship bias in that, if you end up investing in companies that turn into unicorns, you think, oh, yeah, I knew exactly that was going to be a unicorn.
Yeah, yeah.
um, but I think really it's more the case that, you know, there's a lot of different behavioral traits and attributes of successful entrepreneurs, and they can be very different. And you're really just looking for probability distribution of successful behaviors across many different, vectors. And so it's not usually like everybody who's a unicorn is perfect, 5 out of 5 or 10 out of 10. It's probably more that like they're doing two or three things right, but they're probably still idiots in other areas. It's just that they're fast learners and or they're, able to figure out how to hire through some of the issues or manage through some of the issues. And so when you're talking about like can you tell whether someone's going to be successful or not, I think you're really just guessing if they could be successful, and then you're sort of betting on what are the chances of them rolling this 20-sided die 1,000 times and occasionally getting the right answers. I think it's very difficult to know that you're going to be successful from the early stages. You're more trying to say, let me make 100 bets, and maybe 30 of those will get from seed to Series A, and maybe half of those will get from A to B, and half of those will get from B to C. And what we saw, at least at 500, I think after doing over 1,000 companies, probably about 70% of our investments would fail. Maybe half of those fail fast, half of them fail slow. About 30%, 20 to 30% turn into some kind of win, but most of those are small wins that from an economic perspective are maybe less than 5x.
Mhm.
You probably make significant money, and let's call that 10x or better, from maybe in my experience 8 to 10% of your portfolio. A lot of people say 1 out of 10 companies are the ones that do well. And then what we noticed was probably about 1, 2, 3%, maybe 2% that got to this sort of IPO size $1 billion outcome. And again, that might be specific to our particular time in the market or our deal flow or our selection, but I think most people wouldn't disagree that you probably get some interesting wins 1 out of 10 times. You probably get some really big wins, some single digit percentage, and I'm talking about small single digit percentage times. So 1 or 2 or 3 companies out of 100 might turn into those big public. So that just by its very you know numeric nature, I think early stage game, you're not really knowing what's going to happen. You're building a probability distribution curve, for a large number of investments, hoping that a few will get to those large outcomes. And that's
But
generally what we saw.
do you think that repeat founders increase the probability of success?
Yes, I do. In fact, I would say that's probably one of the biggest factors in people's likelihood to succeed is having some experience at doing it. But again, kind of depends on what happened the first time. So some people might not learn from those lessons. So it doesn't mean just because they've done it once, they're actually going to know what to do different. Or,
Yeah, that is true.
some people will get rich on the very first deal and maybe they won't work as hard or don't have as much, at risk or at stake to kind of be successful. I think what we've sort of seen is that people who have learned something and made a little bit of money, but maybe not a lot, who are still hungry, that's probably a good horse to bet on, shall we say. And a lot of the folks at PayPal, I think, were in that bucket because it was an interesting time to build a company where we had just come out of a very big, sort of dot-com blow up, in the 2001 era. And that took a while. It actually took 3 or 4 years for the market to really, recover. It was a difficult hiring market, and so one of the things you saw was there were a lot of talented people at PayPal that at other times in history would have already left and would have already found money to start their own companies, but it was only because that was such a shitty post recovery environment that all those people had to sort of hang out at PayPal because there wasn't as much capital, and also because PayPal was a pretty interesting place. And so you did have an amazing number of people with a lot of talent who stayed in one company for a longer period of time. But then also because PayPal had raised so much money and it merged with X.com, which had also raised a lot of money, the company was pretty heavily diluted when it went public. I think Max, who was one of the original founders of PayPal, only had a couple single digit percentages of ownership. Peter had a little bit more. I think Elon, even though he had left the company, had a little bit more. But a lot of people at PayPal, including myself, probably were like single digit millionaires barely. and
Yeah.
and so a lot of those people were really, I guess I would say, veterans
Needed
of
more.
the internet experience who had learned a lot. in the past 4 or 5 years, but we're still not super rich and we're very hungry for going after it. And if you contrast that with some other companies, I think in particular, let's say maybe Yahoo, Microsoft, Google, a lot of those companies found great success and people made a ton of money who were, just rank and file employees there and probably didn't learn as many lessons just because it wasn't as tough a journey. In fact, I would say probably, the environments maybe at Amazon and PayPal were maybe a little bit more difficult paths than some other companies that had immediate large success like Google and Yahoo and Microsoft and maybe Facebook, although Facebook also had some challenges at different times. So I think it was that combination of sort of not ever being completely comfortable with your position in the market. PayPal was always getting attacked by every different possible front. There's a book called The PayPal Wars written by a friend of mine that discusses some of that, and another one called The Founders that was more recently written. And just PayPal was fighting eBay, was fighting card associations, was fighting other, payment startups, was fighting fraudsters. Attorney generals from different states were suing them even to IPO. And so we always were doing well, but nervous as shit. And I think
Always on
that
the
sort
back
of
foot.
keeps you on your toes when you're never really quite comfortable that everything is working. And so that set of experiences, and also the fact that I think a lot of people were still hungry and not super rich. That was kind of what created, the subsequent explosion of other companies that came out of PayPal, which I think a lot of people comment on.
Yeah.
But
PayPal Mafia, right? That's what they call it.
yeah, but I think again, I don't think people understand that it was, the concentration of talent because it was such a shitty environment probably wouldn't be duplicated even today in tougher environments. The heavy dilution of the company meant that even experienced senior members of management didn't make a ton of money. And so I think that's really more the element of that success was it was a crucible for learning that was amazing. But it was also a tough environment where, there weren't a lot of other opportunities in the Valley, maybe Google and eBay and a few others.
It means timing. The bad timing was good timing as well.
You had a concentrated amount of talent in one company, which is unusual in a very difficult market environment. Yeah. And many of them didn't make a ton of money at PayPal. And so they were still looking for their, I guess we would say second big win, but maybe it was their first big win, really.
So you had lots of success in investing in pre-seed and seed stages. Again, it's all a numbers game as well.
I had a lot of failure.
I know. It's a numbers game, right? It's kind of you invested in hundreds.
In early stage, I think so. Yes.
Yeah. So you made a shift to something very different, right? It's kind of, can you explain what are you building for the past 2 years?
Well, I'll maybe take just a few minutes to talk about the 500 thesis and then what led to the practical VC thesis. So when I was doing angel investing and then when I was working at Founders Fund, I probably made maybe 20 angel investments, 15 to 20 angel investments. I made probably 40 other angel seed stage investments, 20 under the Founders Fund umbrella and another 20 or so through the Facebook FBE fund. Most of those investments did not work. So that was one of the big lessons was even with a larger portfolio of 50, 60 companies, we probably had, I guess I would say 8 to 10 successes out of those, 60 or so investments. Some of them very large successes, but still the majority were failures or things that didn't work. And so that just made me very cautious about, hey, too concentrated a portfolio, I'm not sure we'll have enough shots on goal to really make it work. And so thus was the name 500 Startups, which, pretty clear from the name what the strategy was. People used to laugh in my face when I said that name. In fact, it was very common that people just laughed. They were like, really? You're doing 500 companies? So that was one thing that we kind of, and that was more, from my, background was engineering and mathematics. It was just plain looking at the data that, success happened in smaller, percentages.
Why did you choose 500, not 1,000?
Oh, I don't know. The original name came from
A lot of.
I had a website called 500 Hats, which was it's from a Dr. Seuss book called The 500 Hats of Bartholomew Cubbins, and initially that idea was that entrepreneurs wear a lot of hats. So that was the initial genesis of that. And then from 500 hats to 500 startups was like, well, we need to invest in a lot of companies to have a few that work. So our original thesis at 500 was large portfolios. We ran an accelerator program, but we were also a seed stage investor. We had a very global approach. We were investing in, I think over 80 countries around the world eventually, and we had people in about 20 countries. And we also had kind of a satellite of smaller funds under our umbrella. So 500 itself was a main fund that was global and ran an accelerator program, but we also helped start about 20 small funds, mostly geographically focused, but some that were vertically focused. And indeed, a bunch of other small firms, VC firms, came out of 500 later as well. So, large portfolio, global approach, family of funds were sort of the three things that we were kind of doing, and a pretty crazy pace and irreverent approach. That generally worked really well, but it took a lot of people and a lot of time, and so we've had very successful first and second funds at 500 that are now, I think, 14 and 12 years old. We probably had 10 big wins out of each of those two. Twilio, SendGrid, Credit Karma, TalkDesk were big wins. Canva was another big win. That's out of Fund 2. But we realized, well, I think everybody kind of realized it just takes, not 8 to 10 years, but more like 12 to 15 years to see those wins. And at least for our strategy, it required a very large number of people spread across, the entire world. And even 10 years ago, we were already over 100 people, which was, an unusual size for a VC firm. So I think we solved at least some of the challenges with venture capital in terms of predictability by building large portfolios and reducing the risk profile for outcomes. Both of those first two funds are already, 3x and 2.5x DPI, and still another 4 or 5x unrealized that hopefully will happen. So I think both of those first two funds will end up being 5x net or better. We'll see Fund 3 and 4 are, a little bit younger, but I still think they won't be any worse than 3x net. So I'm pretty proud of the fact that I think we did solve some basic issues with the, challenging nature of venture capital as an asset class, primarily volatility, predictability. What we didn't really address was the fact that those required really large teams, and they still took a long time. And so with Practical Venture Capital, our new firm, what I kind of wanted to try and do was a little bit more of a fund of funds approach, where initially we were going to do a fund that would invest in other small like VC funds. But then along the way, we kind of realized there was a way to sort of cheat a little bit on that strategy and sort of buy those funds after they were already, 7 years along. And so, our little cheat code for what we do is we look for small funds that are doing well, that are between 5 to 10 years old, where either the LPs or the GPs are looking for some liquidity. Sometimes also, the founders and investors in the companies as well. But most of our strategy is based on happening at the fund level. And so we kind of think about cutting a VC fund in half and buying it around year 7 or 8. And so our path to liquidity is now much shorter than a traditional VC fund. And we kind of already know if there are winners in those funds and if they're doing well. Now, you might ask why, if these funds are doing so well, why are people selling? And the answer is, well, if they were institutional size funds or institutional investors, they probably wouldn't be selling. But for small VC funds and this explosion of micro VC funds, which we saw, in the US starting maybe 10, 15 years ago, and around the rest of the world, maybe 5 to 10 years ago, a lot of those people are small investors. They're not always, able to be patient for 20 years. They have, normal events that happen in life where people send kids to college or need to buy a house or have a medical emergency. And maybe some of them are family offices or corporates that have, smaller horizons as well, shorter horizons as well. So we found that some of those folks will sell to generate liquidity, maybe before the end of those fund life. Not everybody, but some. And that was a way for us to kind of find, people who would be willing to sell portfolios that are doing well. So our keyword is kind of like skip the J curve, buy those funds after they're already unicorns, or at least companies on their way to being unicorns. Or if you want to use a sports analogy, showing up at the game at halftime and betting on the team that's ahead. That's kind of how we think about it.
That's super interesting, and it's something that's not being done that much, as far as I understand. Um,
I
yeah,
mean, there are other
that's really
folks that have done
fascinating.
this before in private equity. In venture capital, it's still a little bit unusual for people to buy at the portfolio level, and particularly, maybe only halfway along. And for us, at least, smaller transactions, we're typically doing 1 to 3 million, maybe $1 to $5 million tickets. There are other players that do this strategy at much larger ticket sizes in PE, and even in venture. There's larger firms like Industry and Stepstone that do this. Probably, I would say more at the 25 to $50 million ticket level and up, not as much at the $1 to $5 million ticket.
Must be quite a long sales process because it's quite a big thing, right? Buying a piece of a fund, I would imagine, but maybe not.
I don't know if it's a long time. It probably takes us a little bit of time to do the analysis, but usually most of our transactions are probably 1 to 3 months. We generally want to get things done within a quarter because the data will change every
Mm.
quarter. So we kind of want to look at last quarter's financials, maybe the last year's worth of financials, but we kind of want to find that within a 90-day window before things change too much. It does require a little bit of underwriting and looking at a basket of assets. So we're not just doing, when people do company secondary, you're just looking at a single asset. When you're doing a portfolio, you're possibly looking at a lot of underlying companies. In our case, maybe it's more like 3 to 5 that are the core assets, and then maybe there's another 5 to 10 that might be interesting but not quite as material. Um, but we do have to do, multi-asset analysis and underwriting. We have to think about what's the liquidity horizon for those core assets. So there's kind of three pieces. One is the portfolio interesting? Is there anything in there that we think is worthwhile? And then, how do we price that portfolio when we buy it? Because a lot of things are maybe still held at valuations from a couple of years ago, which are too expensive. We need to think about what the growth trajectory looks like for those assets over the next 3, 4, 5 years, and then we need to figure out, are they large enough or fast growing enough to exit, probably for us within a 3 to 5 year window.
Do you see yourself selling your position to someone else, or kind of what is your
That
exit
happens
strategy?
occasionally. Yeah, I would say we're more of a buy and hold investor. If we were, buying single assets in companies, we have some ability to, offload and sell those assets to other buyers in private markets. But more likely than not, we're buying portfolios of assets where it's difficult to find
Yeah.
a buyer for the same reason that we are buying. There's arbitrage opportunities there. Um, we we probably want to be cautious in our expectations to dispose of the asset. So for the most part, we are, buy and hold investors.
So liquidity is a super big issue right now, right? And I guess, yeah, a lot of if you have money and you are ready to buy positions in funds, then what is the discount that you're asking for?
Yes, this is the question we get a lot, which is what's the average discount? And I would say, the average is maybe misleading. Probably in individual companies, that could be anywhere from 30 to 90%. And for portfolios, it's probably, I guess, more in the range of, say, 40 to 70%. Um, but oftentimes we really have to ask a lot of questions about what the valuation policy is of that fund and the individual companies. Were they companies that raised money before or after Q2 of 22? Because that was,
Yeah.
Q2 or at least Q1 of 22, we were still in the ZERP, crazy money period, and valuations were pretty fucking insane. Starting around Q3, Q4 of 22, valuations were kind of getting back to reality. Certainly in 23 and beyond, I would say things were much more rationally priced. But if we look at a lot of portfolios at the moment, I would say more than half, sometimes 80% of the assets, the underlying assets, have valuations that were set in 21 or earlier. And we kind of know that that's bullshit. Unless the companies have grown 2 or 3x since then, they're probably not worth what they were priced at those timeframes. And for the most part, most VCs have not proactively marked down their portfolios. Some have, and some have selectively, but very few have done that across the board. So first question we ask is, what markdowns have you done in the last 2 years, and is that 0, 1 or 2, or most of your companies? um, and that's a really big indicator of then how we should think about discounts. We are trying to buy at what we hope are 20 to 30% discount to true value, but we might need to be buying at 50 to 70% discounts to NAV in order to really see that. On an individual case by case basis, there could be exceptions, and there's still companies that post 22 are overvalued. There's some companies valued in 21, 22 that are reasonable, but the majority of them, I would say, it's a really big issue about when they raised and what the
Yeah.
valuation policy was from that time, and whether the VCs have marked things down since then.
So it's a great timing for you to apply this model, right? Because you get a lot of
Yeah,
great companies with a
well,
large discount.
there is a lot of stuff for sale. We have to be careful about what we're buying. I tell people there are 3 ways that VCs lie both to themselves and to the rest of the world, and that is their winners are marked too high, their losers are not written down or written off, and whatever the residual value is of the remaining portfolio is still an illiquid asset. And so if you're buying that for cash, you're going to discount that even further. So each of those 3 things is probably a discounting of 20, 30% or more. And in the aggregate, that could be a lot. So a lot of times we end up being, I guess, perceived as bad guys because we talk to somebody, and if they're not sophisticated, they might, say, well, I've got $1 worth of value. And you're like, well, no, you've got 30 cents to 40 cents worth of value, and here's why. And so that can be a difficult conversation to have. I think most people now are realizing the marks on those assets are not correct, and there has to be some amount of discounting, but sometimes they're not quite aware of how much discounting is required.
And what is the difference of buying GP position versus LP position? It's kind of what do you prefer?
Yep. We're open to everything. There's just different economics there. So when we're buying an LP position, we're buying the net position at the time we buy, but we are also inheriting the terms of the fund. We're sort of becoming that LP, if you will. And so we're still paying some amount of management fees on an annual basis. We're still paying, carry on at least the future growth of that portfolio. Some people say, hey, when you're buying LP positions, it's double fee, double carry. And I would say it's not exactly double fee, double carry, because you're at the time that you're buying the asset, you're buying the net position. But the future growth of that portfolio is modestly, taxed, at least to some extent. And even the management fees don't matter that much because you're probably, management fees tend to tail off in most portfolios. You're probably buying at a price that's maybe 2x the original portfolio, which means the management fee on a relative basis is half. You know, so it's really the underlying carry that you're maybe worried about, but only to the extent that that carry is kicking in because you're getting past 1x, and it's really only a concern for the future growth of that portfolio. Now, if you're buying from the GP side, you're probably not buying an asset where you're inheriting the carrier fees, so that could be better. But you might be buying at a deeper discount when you're buying from the LP side than the GP side. If you're buying carried interest from the GP, that could be a really interesting asset, but it might be riskier in that you're not always sure you're going to get to carry or how much carry is going to be achieved. And so sometimes we don't explicitly buy at a specific discount. We might use what's called structure, or we might collateralize a piece of what we're buying. So, maybe we're negotiating to buy $1 at what we hope is worth $1, or maybe, more than $1 in value. But we might also want to get an additional $2 of equity or asset value to achieve a 3x return for our investors. And in case that first dollar doesn't return 3x, then we might ask for additional pieces of those other $2 of assets to get to our $3. Now, I don't know if that's an easy explanation for people to understand, but you know, what a transaction we might look at is, say somebody thinks they have $10 worth of value. We say, well, you really have $5 worth of value there. Tell you what, we'll give you $1 right now, but we want to collateralize that entire position and we want a minimum 3x return on our dollar. And so that's usually done in what's called a forward contract structure. And we're still at risk in case the company or underlying assets don't exit. So it's not a complete guarantee that we're going to get 3x, but it's a way to maybe limit some of the downside.
You're in a super privileged position, Dave, because you've obviously spent a long
Because I'm
time
a
looking at
white
early
guy
stage.
who went to a good college or otherwise.
No, no. I was going to say because you spent a long time, analyzing early stage, and now you're kind of analyzing that later stage. So I guess my question is, are there any common threads that you see, or North Star, or anything like that you kind of any rules of thumb that you could maybe share after looking across those wide array?
Well, like I said, VCs are liars, so you have to discount a lot of what they say because they're. I don't mean that to say in too pejorative a manner. I think if you're in the VC business, you are by nature an optimist. You probably have to believe that unlikely things happen and small things grow into larger opportunities. But we do have to be cautious about how much of that optimism is justified and where the progress of those portfolios are. And so you're correct. Looking at all the early stage investments we did at 500, we kind of know the numbers. We know again that 70% fail, 20% win but aren't very big, and really, most of your big wins are less than 10% of your portfolio. Your really big wins are probably only 2% of your portfolio. So, a lot of that thinking has to be applied when you're looking at where those assets are 7 years later. And so, most of what we do is not super complicated. It's things that I could teach, a generally smart high schooler, maybe even a middle schooler, about valuation, right? Which is usually pretty simple in terms of revenue, margins, and growth. Those are the basic factors of how we think about valuation. You might look at a balance sheet as well for any debt or capital that's been raised in the past as a preference stack, but the exercises of understanding how to value companies is not tremendously hard, at least on an individual company basis. And I could teach pretty much any smart 12-year-old or even not so smart 16-year-old how to do that. And I did that with my kids. At least I did that with my son about 3-4 years ago, and he may have forgotten now, but we went through that exercise. We started testing out some stuff on Robinhood, and I would have him sort of like do that analysis and buy one company a week. Maybe it was only 50 to $100, but it was a good way for him to sort of learn about that. But the challenges are when you try to do that with a larger portfolio, variable size assets, variable growth assets, and particularly imperfect information, right? So when we did that analysis with my son, we were looking at public companies that issued, quarterly reports, and you had full disclosure about what's going on. For private companies, you maybe have access to some information, you maybe don't. There's a lot of lack of transparency in those companies. Even if you're an investor in a fund, even if you're the GP of the fund, you might not always know what's going on, particularly if those companies do very well. You may not have perfect access to that information. You may have been really important when you were writing that first check in the seed round, but after they've raised $300 million and you're not on the board and they have a bunch of other investors who've all put 20, 50, $100 million in, they may not give a fuck about you as much anymore. Maybe at least you don't have as much visibility. Now multiply that times 30, right? and so when you look at these portfolios later now, when we're getting them, you get a report from the LPs and the GPs. Maybe you get some visibility into some of the numbers of the underlying companies, but it's a very fuzzy story to figure out. And the risk that any one individual company will do well or not is high, right? And so you need some amount of portfolio diversification to probably be, comfortable that you're not going to get screwed on any one deal, or that you might not, fuck things up on your analysis. And so that's what I think is really different from maybe individual company secondary buying, where you're just trying to solve for one company, and you have the ability to maybe dispose of that asset if you think you've changed your mind about what it's worth. When you're buying a portfolio, you're really looking at a very fuzzy view of all those companies. They're sort of like, variable in size and growth and trajectory. And because you're buying a portfolio of assets, you can't necessarily dispose of the assets, certainly not individual assets. You're kind of buying it as a block and holding it for a long period of time. And as a result, you kind of have to be pretty convinced that you're buying something that is worth money and growing and that is going to get to an exit. And still, you will be wrong some portion of the time. And so you probably also need to build a portfolio of portfolios in order to have, some level of confidence that those
So,
things are
so,
going to
you,
do
so
well.
you are building portfolio of portfolios, but let's say if you had enough capital, would you buy out the whole fund, or you would prefer to follow this portfolio of portfolios strategy?
I think when you're buying a whole portfolio, you have to question, why is the whole portfolio for sale, and is that a bad signal? And so again, we're trying to take advantage of a unique situation, which is smaller funds, particularly run by people who are less than 10 years in the business, and smaller investors in those funds. They are not perfect in their execution and patience. And so again, if we were thinking about institutional size funds, and institutional LPs, yes, they do need secondary solutions, and maybe that happens more towards end of life when these funds are 10 to 12 years old and older, because they have some, fixed time horizons. Maybe for certain, pension organizations or, other insurance companies, they might have a, horizon of cash flow that they need to manage. But it's not quite the same thing. When you're talking about smaller funds and smaller investors, they are not prepared for 15, 20-year investment horizons. They have life events that happen that require capital. And a lot of people piled into venture, not really, and still do, not realizing how long it takes and how volatile the assets can be. And so they need liquidity solutions, which are, probably not based on the underlying asset, right? And so that's really the issue, is that we can find high quality assets, but from people who do need to sell. And there are not many people who are willing to be the buyer of those assets, either because they don't know about the opportunity, or they don't know how to analyze or underwrite the opportunity, or they don't have a big enough, pocket to diversify across, enough opportunities,
And there are no,
or even that in some cases these are too small an opportunity for some of the larger secondary
yeah,
buyers to go after.
and there is no marketplace like Forge or others for secondaries of fund positions, right?
Well, there are. They're not
There
very widely known. There's a few. In fact, one I was just looking at recently. One that's called Tangible Markets out of the UK. One called UseTap that's here in the US. But they're both still pretty early. There are a few others, but even for marketplaces for portfolios of funds, the underwriting is still not obvious, right? They'll give you access to maybe some of the information, but you still have to figure out what it's worth and put a bid together. And for a lot of buyers, that's a not so simple thing for them to understand how to do. And it's a weird business. Like, I can't say to you that, when I was in grade school, when I grow up, I want to be a secondary marketplace buyer of alternative assets. Like, that's not really a typical like astronaut career trajectory, or even entrepreneur investor career trajectory. I'd been doing venture for 10, 12 years, maybe even more, before I realized the opportunity here. And it was more because I was a customer. I had been trying to sell a piece of my carry in my earlier funds at 500, which had done very well. I thought I would have a very easy time finding a buyer. It turns out I was wrong. It was not so easy. Even 4 years ago, in a very, you know, strong and crazy market, it was difficult to find a buyer for those assets. Um, so I think we just realized there's a very specific opportunity in the market, um, but it's not so easy for the average person to jump in and value a privately held multi-asset portfolio and figure out what it's going to be worth and when it's going to exit.
Do you still do direct investments as well?
I do, just because a lot of people know that that's what I did over the last 10, 15 years, but I'm trying to not get distracted and focus on our main business. Our mandate is primarily about funds and later stage companies. And if we do see early stage stuff, we typically are not doing that out of our fund. We're doing that out of our own pockets. We occasionally do it, but I probably, for this commercial, I should say, no, I never do that anymore.
And kind of what is your recommendation for new fund managers, right? Kind of, let's say in this strategy and this mandate, you are fairly new fund manager, right? And kind of how many, like, what is your horizon when you plan to become a fund manager in this strategy? Do you see yourself doing it 10 years, 20 years? It's kind of, how do you recommend
Yeah,
managers
well, I think
to,
at least 10, probably more
yeah.
like 10 to 15 per fund, and multiple funds, maybe, you're talking about 15 to 20 years. One thing we tried to do at 500 was give a lot of younger people the opportunity to get into venture capital. So we did hire a lot of people who were in their 20s and 30s. We hired people from all over the planet, people who were not just white guys who went to privileged schools, but we hired smart people who were women, minorities, and people in other countries and markets. And we still wanted to find people that were very sharp, but sometimes they were overlooked by other more traditional firms or hiring practices. And I think we did very well with that. Like I said, I think we started a bunch of people into venture capital, probably over 50 people we got into venture capital, and many of them went on to start their own firms. Some stayed at 500 and continued. But I still think the practice of learning venture capital, it probably takes 5 to 10 years to really figure out what the hell is going on. And some people will join a firm and watch and learn from other people as an analyst or maybe as an associate, but they probably don't get to start making investments right away. One thing that's great about syndicate platforms and smaller funds, and we're an investor in a company and firm called VC Lab or Decile Group that helps teach a lot of other people, and I'm also an investor in other programs like Coolwater Capital and another one for women and minorities. So I think the opportunity for people to learn about venture is becoming easier. I started teaching a class at Stanford about 10 years ago called Venture Unlocked that 500 still teaches. And so people can learn about the practice of venture capital, but you still probably need to do it to actually understand. And one of the unique things about 500 was, because we were writing a lot of small checks, we could afford to let people learn and make mistakes who are young. And that's more difficult in large traditional funds when they're doing 5, 10, $20 million investments. They may only be doing 20 or 30 investments per fund. We were doing, in some cases, 600 or 700 companies per fund, 25 to 100K checks. So any individual check was probably like 0.1% or less of the overall, maybe not that well, but 0.3% or so of the overall portfolio. And that gave us the opportunity to let a lot of people get started early. And I think you have that similar opportunity with a lot of these syndicate platforms, and now people writing, angel checks, in some cases as small as 5 to 10K on platforms like Republic, even smaller. But I think you really need to see, let's say, at least 10, maybe 20 investments, and probably over a period of at least a couple years before you start understanding, hey, here's the failure rate, here's what happens, how do companies have, success or not success. And still there's, thousands of different types of thesis for investing, some concentrated, some very large, some that are sector specific. So there's a million different ways to be an investor in startups. But I think you need to have a differentiated strategy and approach to be successful. In public market investing, you have success by probably being an index investor. At least in many cases, that's accessible to a lot of people. In private markets, I think the advice is you have to be different and right, right? Contrarian and right. And so when I talk to people getting started in venture, at least right now, I would say 2 years ago we were seeing 100 different SaaS, or 4 years ago, 100 different SaaS investors who were raising $10-20 million funds, many of whom were very smart, came from great backgrounds. Then we saw similarly a whole bunch of people doing that, in crypto, and a whole bunch of people now doing it in AI or deep tech or whatever. And so right now, if you're running a $25 million fund investing in AI or deep tech, there's a fuck ton of other people doing that too. And so it's hard both to raise capital and to deploy capital if you're not presenting a differentiated thesis and a different reason why people should take your money. So it's important to be good, but I would say it's probably more important to be different first and then good later. And don't take that the wrong way. You still got to be good and smart about what you're doing, but it's important probably to stand out from the crowd, both for raising capital and deploying that capital. And so you really have to understand, what else is everybody doing? How do I present myself in a way that isn't going to look the same as the other 50 to 100 firms that are doing the same strategy?
Yeah. Especially now, there are so many emerging VCs, right? So how do you differentiate yourself? But also, like, we speak with many of them, and they're in the mode, let me try. I will try it. Kind of, they treat it as a startup. And I'm telling them, listen, like, you need to commit for the next 20 years for this career to succeed, right? Kind of, can they be successful
Well,
with
I
one
think
fund?
I think probably a lot of people start as angel investor or participating in syndicates, and they probably don't have as much direct responsibility. And maybe their commitment doesn't have to be that I'm doing reporting to my LPs for the next 10, 12, 15 years. Maybe it's more like, I'm going to deploy capital over the next year or two. I'm going to hopefully have some wins out of that. But maybe, the platform that I'm working with does most of that reporting, and maybe the other syndicate managers are doing a lot of the lead valuation investing. But if and when you actually do start a fund and when you do a first close, life is very different before and after the first close. You are now making a commitment, a fiduciary commitment. Most people don't even know what the hell that word means. But on behalf of your investors, for at least 3 to 5 years in deployment of capital, and possibly for 10 to 15 years in return of that capital. And that is not a small commitment, at least for most people. And most folks don't understand how long that's going to take.
Yeah. Cool. I think we had a great discussion. Like, last question, what is your lifestyle like? It's kind of, I saw you travel a lot. You work a
I
lot. You meet
I
people.
don't
What?
travel or work anywhere near as much as I used to. When I was running 500, or when I was an entrepreneur or angel investor, I was doing a lot of work. And certainly running 500, I was traveling 20, 25 countries a year, probably 6 to 8 months on the road every year, which was a pretty grueling schedule. I mean, really amazing opportunity to see the world and make friends with people all over, which completely changed my life. But I would say these days I'm probably trying to limit my travel to less than 3 months a year, probably not more than 5 or 6 countries. And it's a little bit more sane. I get to see my kids and my dogs. This is my office, so I work from home. Um, I think as you get a little bit older, probably you don't have as much energy to run all over the place, and so we're a fairly small team. We're not doing anywhere near the pace of number of deals we used to. We probably do 15 to 20 deals a year, not 200 or 400 deals a year.
Yeah.
Um, but
And 42 gigs. Kind of, do you join every of this, or?
I didn't get to go on the last trip. That was kind of our rebranding of Geeks on a Plane. We used to do these trips where we took 30 to 40 entrepreneurs and investors to different parts of the world a couple times a year. Um, Now I have other folks who are running that, and I've been going on a few of those trips, not all of them, but there's still a great opportunity to meet other investors and entrepreneurs, learn about different tech ecosystems around the world. We've gone to Southeast Asia a few times. We've gone to the Middle East. We've gone to Eastern Europe recently, and South America. But there's a lot of people doing innovation all over the place now, not just Silicon
Yeah,
Valley or New York or even Singapore and Dubai are great places as well. But I think we're seeing innovation happening all over the world in many different markets and economies.
cool. Great. And okay, last question. Where is the best place to raise money from?
The best place to raise money on the
Because
internet, I guess.
everyone is asking where to raise money for my fund.
I think a lot of people had thought the Middle East was a great place to raise money just because there's a lot of money there, and that is true. I think people underestimate the amount of time it takes to get to know people in different markets. And you know, I personally have spent probably more than 10 years in the Middle East and similar amounts of time in other places like Japan and Singapore, all of which are places that you can raise money. Probably, I would still say the easiest places are where the most money and activity is, which at the moment is probably still New York and London.
Mm,
Those are where a lot of capital is now. There are individual pockets of money that are significant in Hong Kong and Singapore, and Dubai and Abu Dhabi and Riyadh, but some of that I think would say it takes a little longer to
yeah,
get to know. Um,
big
so
investment of time and money to go there, build
yeah,
relationships. Yeah,
but I think probably still it's more a question of you having a differentiated story to tell. Not so much where are you raising from, but what story are you telling is probably the question.
yeah. Because money kind of there is more money than you need, right? It's
If you
just
have a great
you have
story,
to
money
have the
will
right
find
story.
you.
Yeah,
But you still do need to do some marketing and fundraising to find that money. I think again, top financial markets are where there's money to be had. Um, Probably you need to understand what the likelihood of people putting money into alternative asset classes. There's certainly a lot of family offices that are starting to learn about alternative assets, but venture is still a new asset class for them. It's probably still only 5 to 10% or less of their asset allocation. For most emerging managers, you're not going to have access to more traditional institutional investors and larger pension funds and foundations where they might have a lot more capital put to work, but they might need you to be raising a minimum 100, 200, $300 million fund in order for them to write you a check. Um, so it's still usually a difficult place, but again, I would encourage people to check out VC Lab and Dessau Group as one great program to learn more about the practice of venture capital as well as connections with other investors. There's other programs again like Coolwater Capital and I guess another program called GPX that was Plexo was running. Another one called Material Change that I'm a backer of as well. And then 500 and several other people also have venture education programs. That's more maybe about the education side, but they probably
yeah.
also have some good advice about where to find investors.
There is also Dream VC. It's kind of an entity
Okay.
that educates investors
Yes, you're
in
right.
Africa.
I've run across them as well. Yeah.
Yeah, they focus
I
on
do I
Africa.
do think we're seeing more people teaching about venture, which is great. The question is still where's the source of capital for those early
For
stage
everyone.
investors, and
Yeah,
with the exception of a few fund to fund programs that are run on a country level basis, and maybe a few that are commercial that do investors and emerging managers. There's not that many folks that are writing tickets into fund one managers. That's still a big challenge.
great. Yeah, thank you so much, Dave, for sharing your knowledge and your journey. Thanks, Nico, for joining. And yeah, it's kind of we will wrap up the video